Welcome to the Technical Report, Techno Fundamental Report for March 23rd. The Siren's Song, which is Ulysses tied to the mast of the ship, going through the pass that was a shortcut. But the problem was they had sirens that would mysteriously, this is Greek mythology, where they would pull the ship to the rocks. So basically with investment strategy, you have to realize that we all know that the market and the economy are having a difficult time. But you have to stay focused. You have to keep your blinders on. Now, we're focused investors, so here's some of the rules we live with. Concentrate your investments in outstanding companies run by strong management. Important. Limit yourself to the number of companies you can truly understand. 10 is a good number. More than 20 is asking for trouble. Buffett says, be a know-something investor. Know what you're investing in. It says, pick the very best of your good companies and put the bulk of your investment there. Well, that's called pyramiding. We think that's a good idea. Think long-term, 5 to 10 years minimum. Volatility happens. Carry on. So stay focused. Now, what are we focusing on? Well, when I went to business school, we studied something called the efficient market hypothesis, called EMH. And basically the argument is that there are millions of investors around the world, and possibly even billions of people, but they all basically provide information to the market, the buyers and the sellers. So the argument is that the market is efficient. Now, I would even say the bond market is substantially more efficient than the stock market. So there's different levels of efficiency, but what it boils down to is you should listen to the market with your strategy. Now, there was a report that I've referred to in the past. It's called The Agony and the Ecstasy, and it's a report that was done by J.P. Morgan. They went over a 25-year period between 1980 and 2014. And they identified in the report the top performing stocks during that 25-year period. So if you're going to focus, you might as well focus on the best stuff. So if you notice here on the list, the historical winners, you've got consumer discretionary, and then you have consumer staples, Walmart, Amazon, you can just go down the list, Home Depot, so forth. These were the big winners. Now notice how much more of the group was the consumer-related stocks. And then if you look at things like energy, it's kind of a mediocre group. Then if you start looking further, you'll see that the technology stocks were probably, I would say, about the second largest group of good performers. And healthcare was the third best performing group. You could even possibly throw financials in there. But I'm just saying that I think focusing on consumer stocks makes a lot of sense, and I think focusing on technology stocks makes sense. And that's the purpose of the report. Now, why is this important? It's important because you have to identify a consumption cycle based in demographics. So we started a consumption cycle back here in 1982 because the baby boomers turned 35 years of age. So think about it. When you turn 35, you start buying houses, having kids, spending money. So you're going to spend money between age 35 and age 54. That's the spending year. So it's very interesting to me that the largest portion of the population, which is the baby boomers, started their spending cycle here in a wonderful bull market. But we had the crash of 87 in here, which actually was due to Fed Reserve activity. Then we went into a bear market. This bear market, the market dropped 50.5%. That was the 2000 dot-coms. And then here's the 07 financial crisis. We dropped 57.69%. But now it looks like we have started a new cycle. So the question then becomes, are we going to have a consumption cycle? Well, the millennials make up the largest portion of the population right now. And in 2016, the oldest millennial group turned 35. So basically, the millennials in 2016 have now started a consumption cycle. So if history repeats itself, which is a big question mark, this would mean that the oldest millennial will turn 54 in 2035. So the argument would be, or the theory would be, that we stay in a bull market till 2035. Hope it's right. Now, I wanted to take a minute and talk about this indicator. We brought it up last week, and I went ahead and did some back testing on it. And what we're doing here is we're trying to get, again, the market to tell us, this efficient market, to tell us whether we've got a Federal Reserve that's going to be friendly or we're going to have a Federal Reserve that's not going to be friendly. In other words, if the Federal Reserve's raising interest rates, they're taking the punch bowl away. Well, you can see here the rule is that if you get below zero, meaning that over the last 125 days or rate of change, the interest rates started to come down and then they turned back up again. So this was basically saying once it got below zero and back above zero, that the Fed was going to be unfriendly. So we've gone through this unfriendly period. Now all of a sudden here, this is the 5-year Treasury, by the way. We've crossed back below zero for the first time since 21. So does this indicator work and say that the Fed's going to be more friendly? Well, just yesterday they raised by 1/4 point, but in the comments made by Jerome Powell, they have considered pausing. So I think interest rates dropping is a discount of what the Federal Reserve is going to be doing. Now let's just take a look at the stock market. We're not seeing any highs. I keep showing this indicator because until we start to see some new highs of some amount, this market's going to have a tough time. It's going to have a tough time making new highs. Now, I wanted to point out the small cap index. This is really the worst performing index that we're looking at. Now, we look at 5 indexes, and you can kind of see here basically that the small caps, they rallied, back in January, but they have really come down and given a lot back. It's basically saying risk is off right now. Now, the only kind of good news is that we're holding that 200-day moving average on the S&P 500, and we're doing quite well. Actually, the best performing index right now is the NASDAQ, and we're going to see that right here in our aggression index. This is where we're doing a very simple ratio, just comparing the NASDAQ to consumer staple stocks, which is a group of very defensive type stocks. I'm talking toilet paper, ketchup, that kind of stuff. Well, we got a sell signal back here in 21. In February of 21, we started raising cash in our portfolios back here because we broke down below that upper moving average and that upper moving average turned down. Then there was a kind of what we call a dead cat bounce. You got a bounce in the technology stocks. But since then, as we know, 22 was bad. The NASDAQ was down 33% in 22. It was a really difficult year. However, it does look like things are starting to improve here. We're starting to see a turn. So just like we saw the downturn here, and it's been 2 years, we're starting to see somewhat of an upturn. So don't give up on the growth stocks. I think they're trying to turn. Interest rates are trying to get into a downtrend here. If we can hold below the 200-day moving average on the 10-year Treasury note, that would be more of a downtrend in interest rates. They are breaking down. There's no doubt about it. Oil is below the 200-day in a downtrend, and then the financial stocks, meaning the banks, insurance companies, and the brokerage firms, they're in a downtrend as well. So that's not a positive pattern. New lows, saw a little bit of an increase in new lows on the New York Stock Exchange. However, kind of starting to settle down a little bit. I think possibly this bank thing, I just think the market's starting to stabilize. Now, I wanted to feature a company this week. This is one we've talked about before. This is Axon Enterprises. Technically speaking, this is an interesting situation. They announced earnings here. You can see the spike in the volume of buying volume. The stock gapped up, then started to kind of rally a little bit, then pulled back, is consolidating, trying to get going again. Now, this is the inventor of the taser device, and we'll talk a little bit more about that invention and who invented it. But if you just take a minute and look at their numbers real quick. Now, this is as of the fourth quarter. Profit margin, good. Return on equity, fine. And realize they don't have a lot of debt. I mean, they do have some debt. They've got about $12 billion in debt, got $106 million in cash, current ratio 1-to-1. Okay, we're okay there. But if you look at positive cash flow after debt payments, the revenues in the most recent quarter were up 19%, earnings were up 33%. The guy that's running this company is quite interesting, Rick Smith. You know, the studies I've seen, you always want to try to get an inventor running your company because they invent things and they keep things going. Well, anyway, Rick Smith founded this company in his Tucson garage in 1993 after two of his friends were shot and killed. This guy has got quite a degree. He has a B.S. cum laude in neuroscience from Harvard. He has a master's in international finance from a school in Belgium and an MBA from University of Chicago. This guy is trying to invent a way to end killing and invent guns that don't use bullets. Well, we'll just have to see. Is this a Steve Jobs? Well, we don't know. Point being is, keep an eye on Axon. It's on our watch list. Hopefully it works out. If you have any questions, please let me know.